Welcome to Money is Freedom, a podcast exploring how finance and freedom connect in our lives. Created from thoughtful research and narrated by NotebookLm AI, this series brings you clear, meaningful insights into finance and beyond. In episode 5 of Money is Freedom, we unravel the mixed signals in today's economy. With short-term yields down and long-term yields up, a gold surge, and job numbers raising red flags, is a recession still on the horizon despite soft landing indicators? Join us as we explore why market sentiment may be at odds with macroeconomic data and what this could mean for your financial future.
Hey everyone, welcome back. It feels like everyone's glued to the economic news lately, right? Trying to figure out if we're tiptoeing towards a recession or cruising to a soft landing.
Yeah, it's a real head-scratcher for sure.
Well, the article we're diving into today really gets into the nitty-gritty. It's called, "Are We Headed for a Recession Despite Signs of a Soft Landing?"
By Chaos of Money.
Oh yeah, I saw that one, making the rounds.
Yeah, so we're going to try to unpack all these mixed signals and see if we can make heads or tails of it all. What do you think?
Sounds like a plan. Let's dig in.
All right, so first up, the yield curve. Now, I'm not going to bore you with all the technical jargon because I know you're all savvy economic enthusiasts. But let's talk about the elephant in the room here. Short-term yields are dropping, but long-term yields, they're actually going up. What's the deal with that?
Yeah, that's definitely turning some heads. Remember a normal, healthy yield curve? It usually slopes upwards, right?
Yeah.
Shows confidence in future growth. But this inversion, it's like the market's sending us a secret message, and it's not exactly a love letter.
Ooh, think about it. The Fed just cut interest rates, which should theoretically make borrowing cheaper and give the economy a boost. But if investors were really all in on this soft landing idea, shouldn't we be seeing those long-term yields fall too?
Good point.
The fact they're rising suggests some serious hesitation. Like investors are saying, whoa there, hold your horses. We're not quite convinced about this whole soft landing thing just yet.
So it's a bit of a gamble then for anyone thinking about buying a house or making a big investment right now?
Oh, absolutely. It injects a whole lot of uncertainty into the equation. You wouldn't want to lock in a higher rate now, only to watch rates drop if the economy does take a dip.
Oof, talk about bad timing.
And that uncertainty itself can actually contribute to a slowdown. If people are hesitant to invest or make big purchases, it can have a domino effect.
Right, it's all connected. Okay, so we've got this yield curve inversion flashing some warning signs, and then there's another interesting development, gold prices.
Yes. Gold, the classic safe haven.
They've been steadily climbing ever since the Fed made those rate cuts. What's the connection there?
Well, think of gold as the economic equivalent of a warm, fuzzy blanket.
Yeah.
When investors get nervous about the future, they tend to flock to safe haven assets, like good old gold.
Makes sense. It's like that reliable friend you can always count on.
Exactly. It's seen as a stable store of value, even if everything else goes haywire. So this gold rush, it's basically a giant mood ring for investor sentiment. And right now, it's telling us they're not exactly feeling all sunshine and rainbows about the economic outlook.
So are investors essentially casting a vote of no confidence with their wallets? Is this gold rush kind of echoing the message we're getting from the inverted yield curve?
It sure seems that way. Taken together, those two signals paint a picture of growing apprehension. It's like investors are hedging their bets, seeking shelter in gold while keeping a wary eye on those rising long-term yields, hoping for the best but bracing themselves for a potentially bumpy ride ahead.
So buckle up is what you're saying.
Could be wise.
Okay, next up, let's talk about those Fed rate cuts. We know they do this to try and give the economy a little pep in its step, but the article brought up this historical tidbit that really made me do a double take.
Oh, I think I know exactly what you're referring to. Out of 13 significant rate cut cycles since World War II, 8 of them were followed by a recession within 12 months.
Yeah, that's the one. It's a bit of a sobering stat, isn't it? Kind of throws a wrench in the whole soft landing optimism.
Yeah, it definitely injects a dose of reality. But we also can't just assume history is going to repeat itself exactly, can we?
Right, we need to look at the whole picture.
Exactly. The economy is a complex beast. There are always multiple factors at play.
So how should we interpret this historical data then? Is it like a blaring siren or more of a gentle tap on the shoulder?
I'd say it's more like a flashing yellow light, a cautionary tale. It tells us to look beyond the surface and really dig into those underlying economic trends. Rate cuts themselves might not be the cause of recessions, but they often happen when other factors are already pointing in that direction.
So it's all about context.
Precise.
Okay, so we need to view those rate cuts as just one piece of the puzzle, not the whole picture. It's like we're trying to solve a mystery, but the clues keep leading us in different directions.
A very twisty-turny mystery.
Right. And speaking of mixed signals, let's talk about GDP growth.
Good old GDP.
It's one of those terms that gets thrown around a lot, but let's be honest, it can feel a bit abstract.
Oh, for sure.
So for anyone who needs a refresher, what exactly is GDP and why should we care about it?
Essentially, GDP stands for Gross Domestic Product, and it measures the total value of all the goods and services produced in a country. It's like the ultimate scorecard for economic health. A growing GDP usually means things are humming along nicely.
Okay, so GDP growth, good. But the article we're looking at today makes an interesting point. It argues that the recent GDP numbers might be a bit misleading. Something about government spending artificially inflating the growth.
Yeah, that's a crucial observation. So while that recent 8% GDP growth might sound impressive on the surface, we got to look under the hood. If a big chunk of that growth is fueled by government spending, it doesn't necessarily reflect the strength of the private sector. And the private sector, that's the real engine of long-term sustainable economic growth.
So it's like a sugar rush. It might give the economy a temporary jolt, but it's not exactly a healthy long-term strategy.
Precisely. Imagine you're a business owner. Would you feel confident about expanding or investing? If you knew that a lot of the demand for your products or services was coming from government contracts that could disappear in a heartbeat.
Probably not. It'd be like building your business on a foundation of sand.
Exactly. You need that solid bedrock of private sector demand to really feel good about the economy's long-term prospects. So while the GDP numbers might look rosy on the surface, it's important to dig deeper and understand what's really driving that growth.
It's like those before and after photos you see online. Sometimes there's a lot of clever editing going on behind the scenes.
That's a great analogy. Don't be fooled by the surface-level gloss. Always look for the substance underneath.
Solid advice. All right, so we got to be cautious about reading too much into those headline GDP numbers. Now let's move on to something that always gets everyone talking. The jobs report. I feel like people hold their breath every month waiting for those numbers to come out.
Yeah, it's a big one. The jobs report is like taking the pulse of the economy. It tells us how many jobs are created or lost, what industries are booming or busting, and it gives us a sense of the overall health of the labor market.
And a strong job market is crucial for a healthy economy, right? When people have jobs, they have money to spend, which keeps businesses running and the economic engine humming along.
Exactly. So let's dive into that October jobs report. What jumped out at you?
Well, that headline number was definitely a bit of a shocker. Only 12,000 jobs added. That's way below what analysts were expecting. It's like the economy hit a sudden speed bump.
Yeah, it wasn't the robust growth many were hoping for. And what's even more concerning is that the private sector actually lost jobs. That's a big red flag. It suggests that businesses might be getting nervous about the future and are starting to pull back on hiring or even laying people off.
So even if the overall unemployment rate still looks okay, the fact that businesses are shedding jobs is a sign that trouble might be brewing beneath the surface.
Right. And it's important to remember that job losses can have a ripple effect throughout the economy. When people lose their jobs, they cut back on spending, which can hurt businesses and lead to even more job losses. It can become a vicious cycle.
Okay, so we've got these job losses in the private sector, but the report also mentioned that government jobs actually increased. How does that fit into the picture?
That's where things get even more interesting. It seems a lot of the job growth in October was concentrated in the government sector. Now, some government hiring is normal and necessary, but if it's happening while the private sector is struggling, it can distort the overall picture.
So it's not necessarily a bad thing, but it's something we need to view with a critical eye.
Exactly. We need to ask ourselves, is this government hiring sustainable in the long run? And is it creating productive jobs that genuinely contribute to economic growth? Or is it more like using a Band-Aid to cover up a deeper wound?
It's like trying to fix a leaky roof by just patching over the holes without addressing the underlying structural problem.
Precisely. We need to look beyond those surface level fixes and understand what's happening at the core.
Okay, so we've covered a lot of ground here. The yield curve's doing its own twist. Gold's acting like it's about to bolt for the hills. The GDP numbers might be hiding some less than flattering truths. And the jobs report is giving us mixed signals. It's like trying to read tea leaves at the bottom of a very murky cup.
It's definitely a lot to digest.